out. Here we go.
All right, we're here. We're on our SDG virtual cafe, third night in a row. We're glad you're here. Tonight, we are talking to lenders, people that are our backbone for getting us through the deals that we have to do. And we've got two great ones joining us, both from Fairway Mortgage. We've got Susan Yockey and we've got Brian Brockman. You want to just give us just a quick snippet of where you can be found, who you are, and then we'll just jump on into some questions.
Sure, I'll go first. I'm Susan Yockey. My email is susan.yockey@fairwaymc.com, website susanyockeyteam.com. I am in the Overland Park office in Corporate Woods. Obviously, I'm in home in Shawnee for the extended future. So I think Shannon has my contact info. If you have any questions, happy to help you guys however I can.
Thank you. Brian.
And Brian Brockman, also from Fairway Mortgage. Been in the business, gosh, right at 20 years now. Everything seems real normal, so we'll talk about that.
Very normal.
My website, brockmanhomeloans.com, and I've had the pleasure of working with Cammie since Cammie started in the business.
14 years ago.
Wow.
I have a little experience with you.
Yes.
Little. Okay, so here we go. We've kind of got an outline here. We want to talk about interest rates. Obviously, we see a lot of discussion on that and how it affects everyone in terms of refis, but also what's happening with purchases. Talk about some of the program changes from conventional to non-conventional, FHA, government loans, and talking also about forbearance. So I think we're gonna probably just drop in with interest rates. So one of you wants to take off on that topic, would love it. Susan, do you want to start?
Sure, happy to. So I think the name of the game right now is everything's changing. It changes on a daily basis. Brian and I are obviously privy to more information that Fairway is an outstanding resource internally. We get information, an abundance of information daily throughout it's crazy. You wake up in the morning and you have a ton of emails just about this topic. So we have a lot of really great resources. The thing right now is, I think you've probably seen some memes where there's some interest rates are like this. You know, purchase interest rates are really, really great right now. And we actually are focusing a lot on purchase. The refi rates, I think it depends on what your situation is. If you're in a high interest loan right now and refiing makes sense, then we take a look at the numbers and we let you know if it does make sense. It's a case-by-case basis for sure on refis. I think rates are going to be low for a long time. And, you know, I think right now, like I said, purchases is a great time. We're really focusing on that. Brian wants to get into the real specifics on rates. That'd be great. But overall, purchase rates are outstanding, which is great for you guys too.
Susan, what would you say is a high interest rate? Like if...
Whoa, well,
right? I mean,
everything I've been seeing lately, I would say a high 4, 5,
okay.
high right now. We're seeing really great rates. So we just have a lot of flexibility there. So.
Okay. Well, and Brian, you were talking when we were discussing this the other day about what happens with these rates when they drop and why some refi rates are lower with some lenders than they are with others. And can you explain why there's can be issues with refi that we might not really understand that process?
Well, first of all, as Susan was saying, we are a purchase-focused company. We do a lot of refinances, but we're really focused on purchases. It's just the business focus that we've always had. And we prioritize them because if we don't get someone's refinance done, you still have a house to live in. We don't get someone's purchase done, potentially someone's homeless, which we won't let happen.
Right.
And there are capacity issues throughout the industry. And when rates dropped as quickly as they did, there are $12 trillion worth of mortgages that are out there right now. And when rates drop to lows that no one had ever seen, you could have up to $12 trillion worth of capacity coming through the system that's not anywhere near situated to deal with that. So all lenders raised their rates just to slow down the amount of activity that was happening. And I wouldn't say there's a big difference in rates between the majors, of which we are one of them. But some people are doing some things to slow down that activity. I think, and I'm just saying what's public information. I'm not speaking good or bad about anyone, but I think Wells Fargo came out today and said, we are not taking any cash out refinances. They're just not doing it because it requires a full appraisal, as opposed to what they've done recently, which, given the environment, they're doing exterior appraisals only on most transactions, including government. Because if you were an appraiser, you probably wouldn't want to walk into houses right now, and the people in the house don't want you in there.
Makes total sense. Kind of going into the forbearance conversation, I think we're hearing the word and we don't really know exactly what it means, what's happening, and if it's a good thing or a bad thing for us. So let's kind of dig into that a little bit.
Why don't I start, and Susan has thoughts as well that she could add. Forbearance in and of itself, the idea is really customer focused for consumers out there to help them in what is an extraordinary time. And the idea behind it is great. The problem with it is it's only kind of half thought through. While that's great for the people who have mortgages and are in tough times, and it presents them with an opportunity to get through these tough times in a better way, there is the other side of the industry, the people who are servicing these loans, who still have to make those payments to the investors, whether they receive them or not. And there will be a lot, unless there is a major influx of capital to the servicers, a lot of them are going to go out of business. They can't afford to have the number of forbearance occurrences that will occur and still have enough cash to make those payments to the investors, and they'll go bankrupt. And the Federal Reserve actually knows this. They just haven't reacted to it yet.
So for anybody that doesn't even really know what the forbearance is, can you just describe that real quick in case somebody's hopping on and hasn't even picked up on that?
Susan, do you want to get into that, or do you want me to speak some to it?
Yeah, no, absolutely. So forbearance is whenever you have a mortgage, but you are in a situation where you are not able to make your payments on your mortgage. You contact your servicer, because the absolute worst thing to do is just to stop paying. You need to contact your servicer, talk through them with what your situation is. You can get like a 1, 2, 3 month of not paying, but yet on that 4th month, that all 4 months would be due at that time. Now there are some programs, and it depends on your servicer and what your plans are. There are some servicers that will let you, make payments not all at once, or I've seen some that's at the end, it just kind of depends. But like I said, the absolute worst thing is we've seen some people saying, just don't pay it. You got to get on the phone. You got to call your servicer. You have to be patient. It's 3-4 hours of maybe waiting to talk to somebody, but you've got to get on a plan to make sure they understand why you're not paying it. If you can pay it, pay it.
So I was texting with someone the other day about this, and she was basically saying 3 options, and I think you addressed them, but You could pay it at the end, which of the 3 months, which seems kind of counterintuitive. If you can't pay it now, what makes you think you could, pay 3 months lump sum? Push back the payments to the back of the loan, or permanently modify or restructure the loan if there is a permanent hardship versus temporary hardship. Do all those still kind of fall in that category of what you were saying?
Yeah, again, just talking to the servicer and getting the best plan is the best thing to do, because like I said, all servicers can handle it differently.
Gotcha. Brian, what would you continue to add to that?
So you mentioned the 3 options. One is the lump sum in the 4th month if you skip 3, which, as Cammie accurately put, that's going to be quite a challenge because it's just all due and payable, or you're considered late. They can throw it on the end, or they can actually add to the term. So if it was a 30-year term, now maybe it's 30 years and 3 months. So they can break it out. They also can take the amount that you've deferred and split it out over 12 months for you to pay it back over 12 months. That's another option that they've been talking about.
Okay. Do you is there any type, what are you seeing that is the bar that someone needs to meet to even have this happen for them to take advantage of it? Or is it different in every scenario?
It seems to me, as I read through it, if you have a pulse, you can get it. You don't even really have to prove a hardship. If you mention coronavirus having any impact on your lives, and whose life does it not have an impact on right now? I can't imagine much of anyone. Then they automatically go to it. They don't ask a lot of questions. It's not a difficult bar to get over.
It's just the consumer's responsibility to understand how it's going to get paid back.
Yes.
Well, and that's the thing too. Make sure everybody knows that money is not forgiven.
Right. You still
at some point. Yeah.
No, for sure. Shannon, is there anything in particular that you want to throw in there?
Well, this is a strange question that I kind of was thinking. So let's say you are with a servicer that goes bankrupt. What does that even mean?
Someone's going to pick up that servicing,
Okay.
but they'll pick it up on 10 cents on the dollar, 20 cents on the dollar, because it'll have to go through bankruptcy court. You'll still be being charged, and it's due, and the records will still being kept. But if the people who are doing it have insufficient cash, which again, the Federal Reserve is aware of this, but they became aware of it after they threw out the forbearance idea. They didn't think about the other side, which, given all that they're thinking about, I'm not blaming them. There's just a lot to think about, and they're now aware of it and will make adjustments for it. Whether they make them fast enough, I don't know.
So I know you said you're tightening up for federal, those government type loans. Are the conventional, your typical other loans all tightening up too? I mean, is there a total tightening, or is it just government loans?
Jumbo loans are also having an issue currently. And this happened back in 2008 as well, when we had the housing collapse then. We had investors buy up these loans. So we originate them, we sell them to a servicer, and a servicer is servicing them for a group of investors that have bought a pool of loans. Well, the investors have left. They do not want the risk. They do not want the amount of money all tied up in so few loans, because jumbo loans are larger. And they just aren't there now, and they aren't consistently there for people to be able to confidently say, we can sell these loans off to investors.
So getting your hands on a non-conforming loan can be a challenge right now, is what you're saying.
It is, and if you can get your hands on it, it's probably going to cost you a lot more now than it did 3 weeks ago.
Because of the risk for the investor. Yep.
Correct.
Gotcha. What about FHA loans and the risk that could be that's existing, and what are lenders doing about that? We know that they can vary the credit score rates, but tell us why that is and why they've gone up.
Susan?
Yeah, sure. It's the risk. So the credit scores for FHA loans, we could actually originate as low as 580, and Fairway and most lenders have now raised that. And Chandra, I see you have a question here too, and that's right along this. The line of this is we're now at 660 for government loans. And again, just like Brian said, it goes back to the risk. Really sharpening our pencils and having a higher credit worthy borrower. So there's debt to income changes. There's credit score changes. There's reserves, having to have more reserves in the bank. Not just having a gift and that being your down payment and not having anything else left in the your bank account. So a lot of those additional guidelines have come up, and again, it goes back to the risk factors of the type of borrower.
So do those apply to refis as well? Or
Pardon me?
Does that apply to refis as well? All of those? Okay.
So one of the things you did mention, whenever we talked the other day, we talked about how the appraisals for conventional and refis, rate term refis, not cash out, but rate term, we're going to have the drive-by appraisal option. Government did just come out this week too, and that is now an option for that as well, which is great because you know how on a government appraisals, a lot of times they're looking at different things than a conventional. So they are, softening up a little bit there too, but definitely cracking down on higher guidelines on. But the positive of this, and this is a great program that Fairway has, is that if we do have someone that is struggling a little bit with their credit score and they aren't quite at that 660, we have a really great credit tool program we do not charge the borrower for this, and we actually have a team of people that will look at your credit report and give them a step-by-step plan of how to get their credit score up. So I always like to say that we're not denying you, we just can't help you right now. But if we do these things, we'll be able to assist you, in the future. And those credit tool plans are awesome because literally it says to them, you do this, this, and this, and in this time frame, we'll repull your credit, and this is where you should be. So that's always good for those lower credit scores.
That's awesome. Is that something that they can even up their credit scores in a relatively short period of time?
Yeah, it depends. It's a case by case. I mean, if you have some things on there that are in dispute, or you have some late pays, or you have some things that are on there that sometimes all it takes is a phone call to that credit, that line of credit, and you can get some things cleaned up. So again, it's case by case. Absolutely. I've seen some that you can repull credit in 30 days, and I've seen some you don't touch it again for a year. So it just depends.
The tool also allows us to go in there and say, if you have a current balance of, we'll say, $1,800 on a card, it'll say, hey, if you pay this down $200, your credit score will go up 10 points. It'll show us exactly what needs to be done, and we can do that. And then as soon as they pay it, we instantaneously do what's called a rapid rescore, and we get that back very quickly. We want to do it quickly so that nothing else reports in the time period between that might negatively impact their credit. Not to say that happens.
Right.
So would you do that for somebody who even say has a 710 credit score and would like to bump it up so they can get a better interest rate?
Absolutely.
Yes.
Okay. The other thing we were talking about the other day is, thinking about someone applying for a loan now and even going to closing right now and being unsure of what's going to happen with people's jobs, about the EOVs happening at the very end. Can you speak to that employment verification issue?
Sure. We just got new guidance actually while I was on the phone. They just changed it. We were having to do verbal verifications 3 days prior to closing, and then the day of closing, which it seems smart in certain ways, obviously, because of the vibrancy of the market right now, that you would need that, but it's also incredibly labor intensive to have to do it. And I'm still reading it.
I saw that. It said the day, 7 days, and then within 24 hours.
Yeah. So we're not
At first
having.
they were telling us not to schedule morning closings. And now they're letting us at least do morning closings if you call the day before to do the VOE.
So if that's the case, if you're not scheduling morning closings and we want things to fund, then do people need to be considering funding on a day and taking possession the next day?
That was kind of whenever they told us that we needed to do the verbal verification of employment in the morning.
Now we have 24 hours.
Now we have 24 hours, so we're okay to do. In fact, I had a 9 o'clock closing this morning, and it was fine.
And something that Susan and I both enjoy is that Fairway, unlike some other lenders, we always send the wire the day before, and they do not need to call for to be able to access and use that wire. So as they're sitting at the table, it's already funded.
Yeah.
Gotcha. That's awesome. That's one less worry on a part of somebody who's, in the middle of a stressful situation at the very end, moving and so forth. Shannon, what else is coming to mind?
So the last shift, I remember bridge loans and all those things which allowed clients to potentially go in and buy the home non-contingent, right, before they sold the other one, all went away. Seemed like they came back, and we did these other things, recaps, whatever. So in this environment, being non-contingent has been super important. Are those products still available? Are they going to continue to be available? Have they changed?
You could always do carry both as long as your numbers justified you carrying both. So if your debt to income ratio was still within guidelines, if you had a house and hadn't sold it, that's never really changed. You still, as long as you qualify for both debts. And the nice thing again that Fairway does is that if their current house hasn't closed, but it has a contract on it, we actually don't have to count that debt against the person if they have a contract, even though it hasn't closed.
Okay.
And then you speak about recasting. Susan, I don't know if you want to speak to this or if you want me to, but I think there's probably a fair number of people who don't know what that means.
Yeah.
I'm happy to talk about recast. So recast is, so in the situation, you buy a new home, you haven't sold your other one yet. Your debt to income, all that stuff still fits, like Brian mentioned. But then once you do sell the house that was on the market, you have money that you want to put towards your new home. So there are some guidelines, of course, that you have to follow. It's on conventional. Can you do it on FHA, Brian?
No.
No, it's just conventional loans. Minimum of $10,000. You can take a lump sum of money, put it towards the new loan you have, and they will refigure your payment. Your interest rate and all of that does not change, but they do refigure the payment based on the new more loan amount.
And of course, the benefit to that, Brian or Susan, would be the fact that, why would somebody want to do that? Tell somebody that.
To lower their monthly payment, number one.
Well, no, yeah, the benefit of essentially putting the lower amount down, because clearly, people are thinking, I'd like to put more down. Perhaps it's even, I'd like to put 20% down, but now I don't. So if they recast and it takes them to a 20%, then whatever PMI was there is going to automatically, correct?
Absolutely.
Yeah, and it allows them to buy, say they only have 5% for the new house because they haven't realized the proceeds from the sale of their existing primary. As soon as they realize those proceeds, they can throw it at the new loan and take their payment from whatever it was to significantly less. It'll still end. So if they're 3 months into a 30-year mortgage, it'll still end in 29 years and 9 months, but now they'll reduce the payment so that mathematically it works out with this, all the proceeds they just threw at it to end at the same time, but with a lower payment throughout.
Right.
Gotcha. With all this that's happening, do you see that the process from contract to close, time frame wise, is going to change? You think it'll be the same amount of time needed to get to closing?
For a lot of other companies, yes. For Fairway, no.
Yay, right?
I would agree with Brian.
Does anybody else have any questions here that's on?
Chandra, it looks like, asked about the bond programs. The bond programs are still available. Fairway we are taking a 2-week break from doing those for the MHDC and the KHAP. And you know, that's the thing too. It's like, this is all the new normal and everything. And a lot of this stuff is the new normal for a lot of people, but for Fairway, and I think Brian would agree, is this stuff there's some temporary changes right now. Temporary just to get through this unbelievably crazy time that everybody is going through. It's impacting everybody in their own way. And Fairway is, Steve Jacobson, our CEO, he's a really, really smart man. And I think he does everything for a reason. And I think temporarily stopping the bond loans is a good thing. Karen, you're asking about a VA recast. No, you cannot recast a VA loan.
Any other changes to VA loans?
Sorry. What?
Everything else with VA is all the same, right?
Well, except for now that we can do exterior only appraisals, which is a benefit to VA that we couldn't do. FHA or VA always required a full appraisal to make sure that everything was up to government code.
Right.
And now, for obvious reasons and for the foreseeable future until things shake out, exterior is acceptable.
Well, and so to that point, if you had a staircase going to the basement without a handrail that would normally get called out, it just isn't going to get called out this time.
But
it's still a good idea to put a handrail on that staircase.
If you got the cellar, it might be worth noting.
Well, Amy doesn't know, doesn't it?
That's right.
Anybody else have questions? You guys have been very helpful. I think we've covered a whole bunch of stuff, and I'm sure it'll be totally different in 2 weeks, right?
It may be different tomorrow.
Yes, that's right.
Back, we'll be in touch.
I think that's one of the things too I was going to say is, like just Brian said, it changes so much. So really the main thing is just patience and education right now.
And the thing I love about both of you is the time that you will take to educate your clients and talk to them about not just, here's the rate and here's what it's going to cost you, but what are your options and why should you consider something other than what you initially maybe even thought you were going to do right when you walked in the door.
And Susan and I mean, we both do. A mortgage is a tool. It's a financial tool. And how does it fit into your greater financial plan that you have for your life? And that's something that we both spend a fair amount of time talking with them and saying, okay, is putting 20% down the best use of your dollars? Or is something else a better use of your dollars? Have you funded your retirement properly? Or should some money be going there? All those are discussions that as a company, we always like to look at the mortgage as just one part of their financial planning.
Yep. Awesome.
I agree with Susan. Priceless information. Thank you. Thanks, guys.
Thank you, guys.
Thanks for having us.
Yeah.
Enjoy your Thursday, Friday, Monday, whatever today is.
It's Thursday, Shannon. It's Thursday.
I don't even know. It's Groundhog Day. All right. See you guys soon.
Everybody.
Thank you.
Thanks.
Bye.
Bye.